As we heard earlier, Democratic lawmakers have high hopes for new spending, but there are concerns about the notable hike in inflation in recent months. The Consumer Price Index rose 5.4% last month compared to 1 year ago. It was the biggest one-month jump since 2008. Prices for used cars drove a significant part of that increase, but costs for many goods and services rose. During testimony on Capitol Hill today, Federal Reserve Chairman Jay Powell gave his assessment.
Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation. In addition, strong demand in sectors where production bottlenecks or other supply constraints have limited production has led to especially rapid price increases for some goods and services, which should partially reverse as the effects of the bottlenecks unwind.
Chairman Powell was asked a number of questions about the risks of inflation and how it might affect the economy. David Wessel is the director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution, and he joins us now. David Wessel, welcome back to the NewsHour. So fill us in a little more on what is driving these price increases and how significant are they?
Well, it's hard to argue that they're insignificant when you see 5% jump in prices in 1 year. What's driving them in part is that the economy has recovered faster than a lot of producers expected. So you got demand going up and supply is not able to meet it, and that is leading to price increases. And there also are some unusual bottlenecks. The fact that rental car companies didn't buy a lot of cars, so they're not selling a lot of cars on used car lots, is partly responsible for driving up the price of used cars. And similarly, we have a chip shortage that's leading lots of things that use computer chips, which is almost everything these days, to suffer increases in price because supply is constrained.
So was the Federal Reserve and was the Biden administration caught off guard on this?
Yes, I think that, one of the things that Chair Powell said today in the congressional hearing is that inflation has been higher than we've expected and a little bit more persistent than we had expected and hoped. So they knew this was coming, but it's more than they anticipated. And I think that's got some of them a little bit worried.
But they still are arguing, for the most part, as I understand it, that this is not a long-term problem. What is the basis for their believing that?
Well, basically what they say is that to the extent that this is caused by temporary bottlenecks, by the fact that so many more people are getting on airplanes, that so many people are going out to eat, that we have these temporary supply shortages, that's going to abate. And indeed, we've seen a little bit of that already. Lumber prices went up and they came down. Prices of containers, those things that go on big ships, went up and they've come down. So what they're counting on is that this is all a temporary, and once things get a little more back to normal, prices will fall, and the average inflation rate will move closer to the Fed's 2% target.
But on the other hand, as you pointed out, there's another point of view on the part of people like the former Treasury Secretary, Larry Summers, and others who say, no, wait a minute, this inflation should be a big concern.
Right. So people like Larry Summers, Larry Fink, who's the head of BlackRock, a big Wall Street firm, the folks at Bridgewater, a hedge fund, they're all saying essentially that the Fed is too complacent, that while some of this is temporary, they're worried that some of it is not temporary, that housing prices are going to continue to rise because demand exceeds supply, that wages are starting to go up, and they're afraid that the Fed will wait too long to raise interest rates and repeat the mistakes that they made in the 1970s when they let inflation get out of control. On the other hand, other people look at a different historical period and said this is something like the end of World War II. There's a lot of disruption because we've come back from the pandemic, and they expect this to decline. One really important thing is what happens to what economists call inflation expectations. If financial markets in particular begin to build in expectations that we're going to see much faster inflation, that could lead to a self-fulfilling problem.
And what determines whether that's going to happen or not?
Does supply grow enough to meet the demand? And there are a lot of people who are not working now who were working before the pandemic. Do they all come into the job market, and does that temper the pace of wage increases. So it really depends whether these bottlenecks are long-term problems or just temporary as we get out of this very unusual period. I don't think anybody really knows for sure. The Fed is definitely betting that this is temporary, and interestingly, the financial markets seem to believe them. The financial markets are not predicting the kind of big increase in inflation that Larry Summers or Larry Fink are talking about.
David, if the Fed is wrong, what are the consequences?
Well, if the Fed decides it was wrong, and Jay Powell made this point today, they may raise interest rates sooner than people are anticipating. If they don't do that and they're wrong, we could get more inflation. In my opinion, because inflation has been so low, it might not be such a bad increase. But if it's a big increase and the Fed overreacts, you can have a run up in inflation, an increase in interest rates, and then a recession. Historically, that was quite common. It hasn't happened for the last quarter century, but that's the risk. They let it get out of control. They have to react abruptly by raising interest rates, and then we have an unwelcome recession.
Watching it all very closely, David Wessel, director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. Thank you, David.
You're welcome.